This is a video report analysis for VAALCO Energy Incorporated as part of the Burken Road Reports program at Tulane University's A.B. Freeman School of Business. Analysts are Caroline Lacombe, Sam Lazaro, Megan Bogner, and Trace Hancock. Please note that at the time of this report, on March 16, 2016, our analysts used the most recent public financial information in order to construct our report. Our 12-month target price for VAALCO came to $1.80 and an investment rating of market outperform. Today, we will discuss the company description, valuation, recent developments, investment thesis, and financial assumptions to arrive at our analyst's conclusion. VAALCO Energy Incorporated is a Houston-based company engaged in the exploration and development of offshore crude oil in West Africa. It conducts operations primarily in offshore Equatorial Guinea, Gabon, and Angola, Africa. However, the majority of production comes from the Atom block in offshore Gabon. In Gabon, VAALCO's largest block, known as the Atom Marin block, consists of 5 fields with 12 producing wells. The company produced approximately 1.6 billion barrels of oil in 2015. Production from the Atom Marin block accounted for 98% of 2015 production. Despite increases in production, 2015 net income totaled negative $158 million. As of March 16, 2016, VAALCO Energy traded at a stock price of $1.15 with market capitalization of $67 million and 58,289,000 shares outstanding. Our 12-month target price for VAALCO came to $1.80 and an investment rating of market outperform. We arrived at this price by using a weighted average of equity value to proved reserves and a present value of VAALCO's proved oil reserves discounted at 10%. The enterprise value to barrel of oil equivalence model measures the amount of VAALCO's proved reserves to peer averages of equity value to proved reserves of barrels of oil equivalents. We found this valuation appropriate because the company focuses solely on crude oil production and should be valued relative to its close competitors. The present value of proved reserves discounted at 10% method values a company using its current production rates based on its proved reserves multiplied by forecasted crude prices and then subtracted by lease operating expenses to arrive at a stream of cash flows. We then discounted the cash flows at 10% and arrived at a valuation. We then averaged the results from the PV10 and the EV/BOE model to reach a target price of $1.80. As of January 2016, oil prices dropped below $30 per barrel for the first time since December 2003. Additionally, Brent crude oil prices declined $47 during 2015, from $99 in 2014 to $52 1 year later. The substantial decline can be attributed to several factors. First, the Organization of Petroleum Exporting Countries, or OPEC, made the decision to keep production high to sustain its high market share. Additionally, the sanctions OPEC placed on Iran expire this year. Also, there is a general oversupply of oil, in part due to the increase in American supply over the past 10 years from new hydraulic fracturing technology. Looking ahead, the Energy Information Institute estimates oil prices rising to $40.15 per barrel in 2016 and near $50 per barrel in 2017. The current state of depressed oil prices forces exploration and production companies like VAALCO to reevaluate business strategies. On January 26, 2016, VAALCO announced its intentions to pursue strategic alternatives in the upcoming months to maximize shareholder value. As stated in the press release, these strategic alternatives could include the acquisition of additional capital to increase the liquidity, fund projects and stimulate growth, or perhaps the sale of VAALCO's assets, or even the potential sale or merger of the company. VAALCO could also continue its existing operations. One thing about VAALCO's current operations that sets it apart from its competitors is that the company has very little debt on its balance sheet. The only debt recorded in VAALCO's financial statements is $15 million from its revolving credit facility, commonly referred to as a revolver, which acts as senior secured loan in which VAALCO can use the funds or draw them down at any time within the loan's terms agreement and then repay the debt or repay by a certain later date with interest. This revolver has a semi-annual borrowing base redetermination, and on March 2, 2016, the borrowing base dropped from $65 million to $20.1 million. The original use for the revolver was for capital expenditure related to exploratory wells in 2014. However, the company continues to hold the revolver as a reserve and a cushion in case the current oil downturn continues for longer than expected. Unlike many of its competitors, VAALCO's relatively low amount of debt leaves the company in good standing because it can focus on greater production when prices rebound, borrow at lower rates, and pay back equity holders faster. In 2015, VAALCO conducted a cost reduction initiative with full benefits to be realized in 2016. One of the main methods used in the initiative was a reduction in general and administrative costs. The goal of this initiative overall was to return VAALCO's general and administrative expenses back to pre-production levels so that the company could put extra money towards furthering its production capabilities. VAALCO incorporated this initiative by cutting executive and management cash compensation by 30%, shrinking corporate staff in Houston by 15%, trimming travel costs significantly, and decreasing contract recapturing costs by only maintaining relationships with its current partners and not negotiating any new contracts with new partners. In total, the general and administrative cutback will save VAALCO $3 million in 2016 to be put towards production. In 2015, VAALCO discovered hydrogen sulfide, or H2S, in 2 of the 3 producing wells in the Abori fields, the Atom 5H well and the Atom 8H well. The presence of hydrogen sulfide sours VAALCO's oil so that the oil cannot be sold without sweetening the spoiled product. Efforts to remove the H2S from the sour crude cost VAALCO $700,000, and the discovery resulted in a decrease of approximately 10% of gross daily production. However, in late 2015, VAALCO halted its crude sweetening project to remove hydrogen sulfide from its oil in offshore Gabon because of the severity of the current oil climate, which made the project uneconomic. VAALCO plans on deferring the project until oil prices recover. The company will not resume crude sweetening projects until oil prices reach $60 to $70 a barrel. VAALCO experienced drastic managerial changes in the past year. After engaging in a proxy contest that ended in a settlement agreement with Group 42, an independent investment collective, VAALCO incorporated many changes into its board structure. The first change limits VAALCO's board of directors to 7 members, with the possibility of appointing an 8th member in 2016. Other changes in the board structure include the retirement of 2 incumbent directors. Group 42's chairman, Michael Keene, now serves as VAALCO's vice chairman and leads its corporate governance and strategic alternatives committee. The settlement also mandates the appointment of an undisclosed second independent board member that represents a separate shareholder in the company. The board also decided to separate the chairman and CEO positions and named an existing board member, Andrew Falthrop, as VAALCO's chairman. The goal of these changes was to maximize shareholder value for all holders. In order to project oil sales into the future, our team constructed a production model in order to forecast yearly production levels and then convert those yearly values into quarterly earnings data based on the Burken Road oil price deck. We lowered the Burken Road price deck by approximately $5 because VAALCO has historically sold its oil at a discount to Brent. In order to forecast 2016 production levels, our team took the current flow rates of the field production in the 4th quarter of 2015 and applied a 2.5% decline rate to the level of production. Due to the current low oil prices, we did not include any additional well production for 2016 and 2017. All production numbers for 2016 and 2017 are based off of the existing wells in operation. Our forecast for capital expenditure, or CapEx, was directly reliant on commodity pricing. We used the oil price index as the primary driver for revenues for the company. Based on management guidance, our team set a trigger price for the drilling of new wells of $55. In 2018, our oil price assumptions rise above $55, causing the new drilling of new wells. After our meeting with management, we found that the company would start drilling with 1 new well for every year for 2018 and 2019. Quarterly, we increased CapEx by 25% of the cost of those wells. Based on this data, we assumed that production would increase incrementally, segmented between the declining existing wells and the new wells coming online. For years 2020 to 2025, we assumed a continued rise in oil prices and therefore an increase in CapEx. According to management's guidance, we assumed once oil prices hit $80 a barrel, the company would start additional drilling. Our team forecasted 3 wells every 2 years for 2020 through 2025 and increased CapEx and production levels accordingly. VAALCO plans to cut production expenses in 2016 in two ways: reduction in the work inefficiencies and reductions in material and service costs. The company intends to decrease work inefficiencies by reducing helicopter usage, marine vessel usage, and chemical programs. VAALCO expects to cut material and service costs by conducting a workforce realignment, optimizing its marine vessels, and dropping miscellaneous costs including vehicle and consultant costs. On a per-barrel basis, production expenses dropped from $19.36 in the third quarter of 2015 to $16.50 in the fourth quarter of 2015. This nearly 15% reduction in cost per barrel allows VAALCO to remain competitive in an unforgiving oil climate. We assume no change in the fixed costs associated with exploration and production, but that those costs would be spread out across a larger production base as new wells are added in the future. Finally, the company's low long-term debt structure will help the company compete and survive in the current oil pricing environment. We believe that the rebound of oil prices will lead to an increase in the company's revenues partnered with a corresponding increase in capital expenditure. The increase in capital expenditure will expand the company's production capacity and allow the company to continue to grow.